Today, you are going to learn about the crypto world and the opportunity it presents. And with the right knowledge and the proper mindset, it can make all the difference in the success you achieve. So if the market smells blood, they will attack. This is what our show is all about. The mindset that when the financial markets or your life take a downturn and people around you move to fear, it's time to move to greed. It's time to see more opportunity. This is the mindset that the real winners have. So to introduce today's guest, Tania Reif. She is the Chief Investment Officer of Senda Digital Assets, a crypto-focused investment company that sees enormous long-term potential in the crypto world. Tania, welcome to Titans Up today.
Thank you. Delighted to be here.
Excellent. So when did you first discover that investing was for you?
Actually, it was a slow process. I have to say, I grew up in Venezuela. We had a lot of currency crises, financial crises. Initially, I got into economics and finance to understand what happened in my country and why we had all the turmoil we had. And initially, my intention was really not to move to investment. It was to work at the International Monetary Fund, which I did for a few years. And we went around the world looking at different economic regimes, different countries, give advice when we could, do program lending, program negotiations in some other cases. And that's how my career started. It was really in the mid-2000s where I got lured into the private sector, into Citigroup, and I started looking into the world of investment and the ups and downs, the interesting dynamics that would, come up with that really booming sector at that time. And eventually, in 2009, I was hired by Soros Fund Management, and that's how I moved from the banking side to the hedge fund side, and that was just very exciting to understand how these big investors made bets on the market, and how we could use the knowledge that I had gathered over the years on financial markets to profit, in some cases, from unsustainable situations and to finance sustainable ones and to finance proper opportunities. So it was a slow progress into the investment world, and now I'm very excited to be involved in the crypto world. It's an extra step in financial innovation, financial inclusion, and it's very exciting times.
So then what was the process like of mastering your craft throughout that? What were some of the experiences that you had that were maybe turning points and helped you to learn faster than you normally would have?
I'm not sure if my path was the fastest way. I think everybody has their own path to investments, and certainly my path was not the traditional path. A lot of the people involved in trading start out in the very early years as traders, market makers in the banking sector. That was not my case. As I said initially, I wanted to understand the economics and the currency dynamics that were really affecting the country where I grew up in. And I ended up doing a PhD in economics at Columbia University. So it was a very academic start. I started in understanding the fundamentals, the theory, the econometric analysis, the empirical side of things, the theoretical side of things, and just looking at it from a very academic standpoint. That's very unusual in the trading universe. So it does happen, but I think it is not your typical path. So that's why I wouldn't say this is the fastest path, but it certainly gave me a different perspective. By the time I moved to the public sector, to the International Monetary Fund, I got a flavor for what the different political powers, how that affected decision making in the financial world, in the policy world. It was not only about understanding the economic dynamics and the financial dynamics, but where the balance of power lie in the world and the geopolitical factors that you had to take into account. That was very important piece of knowledge and information. And I took all that academic understanding and then all that public policymaking understanding when I moved into the private sector. And that's where I complemented those two: private sector mentality, the profit-making mentality, the trading mentality, the how do you make money out of the volatility in financial markets. And when you put all these things together, then you have a pretty robust, well-rounded background to be able to make educated bets in financial markets. And I think that's why my background is unique and it's well placed for understanding the currency world and the crypto world in particular. It may not have been the fastest, but it's certainly a well-rounded background that I can rely upon to make my decisions.
Definitely. Now, you mentioned profiting from volatility, and for most people, that is a totally foreign concept. People think that the market goes up and that's how you make money. So what is it like profiting from volatility? What are some of the ways that people are able to win, even when it seems like there's no way?
It is important to understand that when you're betting on markets, you're taking a bet and you are thinking of risk and uncertainty. It's not a one-way street. It doesn't just always go up. If it was that certain, it wouldn't be that profitable and it wouldn't be risk-taking. It would be a certain outcome, invest in the safest possible asset. Maybe you can think of a US Treasury bond and get a fixed payment, a fixed coupon, and so on. But that's about it. Anything else, if you're investing in the stock market, if you're investing in the crypto market, if you're investing in commodity markets, they have huge volatility, a lot of uncertainty, and a lot of risk. So investing really is about risk management. How do you manage that risk? How do you make the bets that make sense, that you can have the highest degree of return for the lowest amount of risk, but understanding that there's always risk. You can lose the money that you put into investments, and it's not a one-way street. So a lot of what investment is understanding those risks, measuring those risks appropriately, building a portfolio that has a diversified amount of risk, that these risks are not correlated, so they protect you in the downturn, that you have the appropriate amount of risk that you're taking, so that if you were to go through a big downturn, you don't just blow up all your savings and you don't put you and your family at risk. So it is all about risk management. When somebody, if you are going in for a job and you get a salary, there's risk there, but it's a lot more certain. When you're investing in financial markets, it's very uncertain, very volatile. And that's even more so when you invest in the crypto market, because the volatility is even higher. So it's very important to understand that investing is about risk, is not about a certain outcome. We use all this knowledge that I talked about, knowledge about fundamentals, knowledge about technicals, knowledge about public policy and how that interacts with private incentives, to make educated guesses in taking risk and then manage those risks appropriately. And I would just allow myself to insert here that a lot of the problem we saw in the crypto world over the last quarter had to do with poor risk management. So when you have poor risk management, you maybe believe that you are investing in something safe and reliable when you're not. And then you wake up and you have a huge amount of losses, and that's a problem.
Yes, I saw an article that you had released, a paper on Terra and what had happened there.
Yeah, Terra Luna, what we had happen earlier in the second quarter of 2022 was we had an episode of a breakup of what they call a stablecoin peg in the crypto world, which is really a version of a peg of a currency to a US dollar, very similar to a lot of the pegs that we see in the emerging markets worlds today, where they try to maintain the peg with insufficient reserves and with a very high unsustainable interest rates. So they lure people into these pegs, promising a stability in the currency and very high rates of returns. So you have a fake stability. And when there is no proper vetting of these protocols in the case of cryptos, or these pegs, the fundamentals in the case of emerging markets, these pegs can be unsustainable. And when they do blow up and people suffer big losses as a consequence. So it is important when you make your investment that yes, volatility is natural. Sometimes, like you said in your intro, when there is a lot of fear, it opens opportunities in things that are of good quality and are cheaply valued. But there are things that are not of good quality, that are not well designed. There are Ponzi schemes, there are frauds, and you need to do proper vetting before you invest, because those things will go to zero and will disappear. So in order to do responsible investment, you have to do your homework, make sure you know where you are putting your money. And once you do that, then yes, you can take advantage of the volatility, and moments like this, when there's cheap valuations, are good opportunities for properly vetted, good quality assets. And that's true in the crypto world and the traditional world.
Absolutely. Things are going to go to zero. You just have to look deeper in, like you said, the fundamentals. But even in Terra's case, like you mentioned, there was the financial architecture was the problem, not code. It was actually what was truly behind it. So explain more
Exactly.
about why that's important.
Yeah, that is important because a lot of the people that do not understand well the crypto space, when they see an implosion like this happen, they say, see, it's the technology. There's a problem with the technology. You can't trust the code. You can't trust the technology. What we just saw happen last quarter was not about the technology. There was not a consequences of hacks or bugs or problems with the codes or problems with the blockchain. None of that. It was a problem of an unsustainable peg. It's a problem with the design, the financial architecture design, if you will. And unsustainable pegs we see in the crypto markets, we see in traditional markets. It's not a crypto specific thing. It is a poorly designed stablecoin peg, but we've had poorly designed emerging market pegs as well. Anything that is poorly designed and is unsustainable, eventually the market will attack and they will win because it's unsustainable. So that's where vetting these things properly comes into play. And it doesn't mean that there is a problem with the technology. The crypto technology is actually amazing. In my view, it is going to be very disruptive. It's going to open a lot of doors, a lot of financial inclusion, a lot of possibility of tokenizing on different assets that we can't even imagine right now. But it does mean that because it's a new technology, before investing in anything crypto related, you have to vet it properly and you have to be careful with it. As I say, the technology is fantastic, it's fascinating, it's exciting. However, it's not black magic. I like to say it's not going to create yield out of thin air. So if somebody's promising a very high yield, you want to ask yourself, where is the yield coming from? Make sure you understand things properly, and if not, find someone that can help you understand it or do some research before you invest. Because just because it's an exciting new technology doesn't mean that they can offer very high yield with low volatility. Those circumstances are very unusual. If you have high yield, you're probably incurring some risk and you want to understand those risks. I'm not saying don't ever take those risks. Maybe they are worth taking, but you want to understand it properly. And I think a lot of people that were involved in the Terra loan did not really properly understand the risk they were taking. And that's why we saw the big consequences and big deleveraging that followed the following month.
And then there was a tweet I read yesterday from the creator of Ethereum. He said, there's a lot of things, a lot of mental gymnastics that goes to defend things that should be able to be debunked with 12-year-old logic, as in if it provides more than a 20% APR return, it's probably a Ponzi scheme. That was his tweet. I thought it was rather
higher than 20% return in a stable asset. It's like I say, it's very unusual. I don't want to say it's outright impossible because there are things that maybe you can generate that at least for a short period of time or for whatever reason, or maybe you are aware of the risk and you understand, okay, I'm going to get 20% for a fixed amount of time, but I know this is unsustainable. I want to get out. I wouldn't advise that. Some people do that. My point is, I don't want to be draconian in saying yes or no, but what I do want to say is, if you're getting 20%, there is probably a risk there. You want to understand the risk. You want to understand where that 20% is coming from. And if the source of that 20% is not sustainable, if there's no revenue stream behind it that can sustain it over time, then eventually it's going to collapse sooner or later. Is it going to be a matter of a month, 2, 3, or a year? There are many things that come into play in that, but you are taking a big risk. So never invest in something that offers you a yield without really understanding how that yield is generated. Unless, of course, maybe you want to invest in a bank that is FDIC insured, and that's a different question. But in the crypto world, we do not have FDIC insurance and we do not have lender of last resort. So when you invest in crypto, you have to be very careful. I think the technology is real. It has legs. It's going to be disruptive and it's very exciting. But there is a lot of fraud out there and a lot of dangerous games. So just be very careful and do proper research before investing.
So let's talk about two big moments in the world. One is actually George Soros's most famous trade, which I'm sure you know very well about. It was, I believe, 1987. Is that correct? I know it was in.
It's actually another peg, right? It's he bet against a peg that eventually was unsustainable. So this is another example of, obviously, I wasn't there when all this happened. No relationship to that, but just in general, I have traded against unsustainable pegs throughout my career. It's actually that hedge funds do routinely, and not even hedge funds, just actually locals. In my country, Venezuela, for example, when the peg looks unsustainable, everybody goes and buys dollars. And people do that in other countries around the world. You can think of Nigeria, you can think of Egypt, you can think of the Asian financial crisis. This has happened time and time again in many countries around the world. There is an unsustainable attempt to peg the value of a currency to the US dollar. And in order to do that, you have to have a lot of reserves in dollars, which was not the case in the Terra Luna debacle, because they used actually Bitcoin as reserves, which exacerbated the meltdown. And in other cases, they just don't have enough reserves to sustain the peg. And so when that's the case, it's unsustainable. And the market, the hedge funds of the world, the investors of the world, the local residents of the country, they will all bet against it. And eventually the pegs that are unsustainable do collapse. And we've seen it over and over again throughout the years. And if anybody attempts to do another peg in the crypto world or outside that is unsustainable, it will collapse again. And so it's up to us, the investors, to do our proper due diligence and our proper homework and make sure that we invest in the safest possible places and avoid those risks of blowups as much as we can.
And you actually brought in the other scenario I was going to bring up. So my wife's family, my brother-in-law, all from Venezuela. And one of the things, when I first met my brother-in-law, we had very long conversation, and he told me something. He had just come from Argentina, obviously lived in South America his whole life. And he said, Jacob, it's really interesting because here in the US, there's many different topics that are at the forefront. At the time, it was COVID and other things like that, and the race riots that were going on and all those things. But he said in Latin America, not like that at all. It's all about currency. It's all about the exchange rates and how, oh man, if I'm going to go here, I need to do this. And there's this financial game that's going on. So maybe a little bit more insight on that. And then I'd also like to go into the Venezuela situation. What happens when something like that happens with a country? A lot of people know that a currency gets devalued and other things, but what are those internal characteristics and fundamentals that are occurring that are driving, strictly from a financial standpoint, barring, let's say, political things, of course, unless you'd like to bring some things in.
It's quite interesting. I actually like to say that all Venezuelans are FX traders, and probably Argentinians, because it is true. Our life is why, it's probably no surprise that I got interested in crypto, and I'm doing what I'm doing now because we have the motivation since we are very, very young, and we grew up with all these currency crises. The reason this happens is because in a lot of these emerging markets, we actually export commodities and we import pretty much everything else we consume. I'm obviously exaggerating a little bit, but it's an easy way to understand. Take the case of Venezuela. We export oil, we import computers and food and manufacturing and pretty much everything. What happens is the government receives revenues in dollars, but the public consumes everything in local currency. When the country runs into financial difficulty, into fiscal difficulty, if it can't finance itself, if it devalues the currency, what happens in terms of local currency, each dollar it gets from their export of the commodity, in the case of Venezuela, oil, in the case of Argentina, are agricultural commodities, right? Then each one of those dollars that they get in revenues, it's worth a lot more in local currency, so they can pay government expenses, they can pay wages, they can pay for infrastructure projects, etc. So the government is more fiscally viable after a devaluation, and they can get themselves out of trouble. Now, think about it from the layman in the country, from the locals, like people like us. If we are earning in local currency, our wages in local currency, and you have a huge depreciation of your currency, and these things can be big, 50%, 80%, 100%, etc. So from one day to the other, you suddenly, all the things that you're buying that are imported, they double in price or more, right? Because
Wow.
you're still earning in local currency, but everything that you are importing and that you are consuming is priced in dollars. And so in local currencies, worth twice as much. So now the government is more solvent, but the people, the laymen, the consumers are more insolvent. The real wage is basically your wage adjusted for inflation. So effectively, we get big inflation because everything, all the prices of everything we consume go up very quickly, and our wages are the same. So we get a huge shock to our purchasing power. And of course, that helps with the macro balances, with the fiscal balances for the government. It helps with the current account for the country. But for the individuals, it's very painful. And this is an example of when there is conflicting interest between the government and the central bank that has the public interest in mind and the individual who wants to protect the value of their savings and their income. And how you get to that situation, of course, it's a longer discussion than we have time now. But the point is, when this currency crisis happened for the individuals in the country, it's very painful, very dramatic, very sudden. It's very hard to navigate. So what has happened over the years is that in countries like Venezuela and like Argentina, they have used these big currency devaluations to square the fiscal balances. And as a consequence, the individuals have time and time again suffered this big decrease in purchasing power. Every couple of years, they get another one of these episodes where the decreases are very big. In the case of both Argentina and Venezuela, they also restrict the ability of the locals to purchase dollars so that they can, save in foreign currency and avoid suffering these big drops in purchasing power. And in the case of Argentina, actually, they earlier in the 2000s, they actually blocked the ability of the individuals to take their money, their dollar deposits out of the banks, and then they devalued the dollar deposits in local currency. So it's been very traumatic over the years for people like us, and that's why it's not surprising that we suddenly find attractive the idea of crypto, the idea of Bitcoin, to have an alternative currency where you can put some of your savings. And despite the volatility, you may think maybe crypto is very volatile, but compared to my local currency, maybe not as much. And anyway, there is a lot more to that, but that's really why everything revolves around the currency, because the currency really is what determines inflation. There are many other factors, but when you have these big currency depreciations, it really feeds to inflation very quickly, and it affects the livelihoods of everyone immediately. So we are all very aware of where the currency is trading every day.
So we're going to open up a bigger topic about bringing that policy experience that you have. We're going to connect it to the crypto world, really two situations again. You mentioned Argentina, Venezuela, but El Salvador bringing on Bitcoin. And do you think that was a great move? Based off your explanation, it sounds, and again, I never heard of it articulated that way.
So let me just give the disclaimer of I'm not an expert on El Salvador, so I'm not following with detail exactly what they're doing. But more generally, what I would say is the following. I think for a country, especially an emerging market, to have a percent of their reserves in Bitcoin is not a bad idea. I think it is likely to appreciate over time. And I think it diversifies the reserves. I think it's, I don't know what the right percent is, but maybe you want to have a 1%, a 5%, whatever it is. I don't think that's a bad idea. I think that's a good idea. Making, however, something like Bitcoin a legal tender, then it depends. Because what you want to do is you want to give the individuals in the country the choice to invest and transact in crypto, in Bitcoin, in this case of El Salvador, if they want to. But I don't think it's advisable at this stage in the game to force the individuals to accept Bitcoin. So if you're telling grocery store owner in El Salvador that he has to take Bitcoin as a form of payment, It's a problem because Bitcoin is very volatile nowadays. It's still a nascent, it's still underowned. That means that the volatility is going to be very high for time to come. When it's a more widespread and it's a more liquid market, probably the volatility will decrease over time. We have seen the volatility actually decrease over time, believe it or not, but it's probably going to continue. But in the short run, it's still going to be very volatile. So for that grocery store owner to try to have their accounting in something that is so highly volatile and to force them to accept Bitcoin, I don't think it's advisable. I don't think it makes their life easy. Now, to give them the option to accept Bitcoin if they so want to, I think that's fine. I don't see a problem with that now. And I'm not an expert in El Salvador, so I don't know exactly what they're doing and how they're going about it. I think if it's optional, it's okay. I wouldn't force anyone to accept it if they don't want to. Dealing with the volatility right now, it makes it very hard to run a company or a business with that kind of volatility. It's not at the stage that it's ready for that yet.
Yeah, I couldn't even imagine. It makes me think there's going to be a lot of very educated people coming out of El Salvador, let's say in 50 years, who have had to deal with this, kids coming up learning about cryptocurrency and all those cryptography, right?
I mean, learning about it, I think is good. I think learning what it is, how it works, what's good and bad about it, what are the risks, what are the costs of transacting in it. I think learning and knowledge never hurt anyone. So I would encourage everyone to learn about it and understand it. And if you want to transact in it in a small amount to get comfortable with what it is and how it works, I think that's a good idea as well.
So how has your mindset over your career changed towards risk management, your mindset and your attitude?
Risk management is something that you learn, a skill that you learn not only the technical skills, but also you learn from experience. I think that there are two things that are important. There are many things, but I'm just going to highlight two things. One is to understand that timing is very important in markets. You can't fully time the market, so that's impossible, but you can make educated guesses. If you are right but you're too early on a trade, you can lose a lot of money, and if you're right and you're too late on a trade, that's true as well. Sizing your positions appropriately, diversifying the book appropriately, trying to read the risks in the market is very important to be aware of how to time these things as best you can. And the second thing is to remember that you control your inputs, but you don't control the output. The ex post result of your trading is going to be a consequence of a lot of things. Some is your risk management skills and your investment skills and your analytical skills, but some of it are unforeseen risks that you can't control. Some that help you, some that hurt you. And the only thing you can do is to prepare as best possible before the events happen. And sometimes you get lucky, sometimes you don't, but it's really not the outcome that you want to focus on when you're trading. It's not the particular P&L of the day or the month or the year. Is if you consistently try to do the best you can in having a process and a strategy that is wise and that is likely to deliver returns in the long run, then it's a repeated game. And even if you have a couple of downturns, if you continue to do things responsibly, you will have an opportunity to get back up.
Excellent. A lot of people can gain from that mindset. I know there was I laughed in there just thinking of back in some trades I've done and other things like that as you were talking. So definitely good information there. So how did you know it was the right time to begin?
So the crypto space has been evolving steadily since the last decade or so. I think it was early stages. There was a lot of uncertainty on the regulatory front. There was not much institutional infrastructure to get involved. But after 2017, 18, you could see a lot more formalization coming to the market. You could see a lot more serious players getting involved. You could see that things were getting more mature and ready for, I think, institutions and professional investors. So I started to get curious about that at that time. But really what I think was a catalyst is at the early stages of the pandemic. very early on, you could see in the March of 2020 that all the central banks were shifting into very accommodative monetary policy. So they were injecting a lot of liquidity to help the world weather the pandemic. And when they did that, that huge amount of liquidity was going to be a tailwind for all risk assets, and particularly for crypto, because crypto was so underowned. So the ability for crypto to actually rally behind that was very big. I was excited about that. And when there's a big rally, there's a lot of interest, and there's more and more players coming in to make it more formal, to offer more services, more exchanges, more liquidity brings in a lot of interest. And that's what happened. And during that process, I got interested in jumping into the space in a more formal way. And that's when I knew it was time. So we launched on April 1st. So we're trading live the strategies since April 1st.
Awesome. And then I've, again, from that paper that I read about Senda and your philosophy, you have a diversified basket of cryptocurrencies that you're obviously doing your analysis for. So how are you making sure to choose the right things?
Yeah, so it's what is interesting about the crypto space is we actually have a lot of data. We have a lot of on-chain analytics that we can follow. What we do in Senda is we have a method of following all the fundamentals in the crypto space. We have an algo that helps us track all of these different tokens. I'm going to just call them tokens. Some people make a distinction between coins and tokens, but it's easier to refer them all as tokens. So we track all these tokens. We're tracking around 40 right now. We put a market cap cutoff around 2 billion because we have a very liquid strategy. And we do a proper vetting. So we make sure that all the tokens that we look and we follow are proper white papers, that they are not frauds, they're not Ponzi schemes, that they are serious projects that have potential. And then what we do is we track the fundamentals. We have everyday rebalancing, and we track, say, if there's activity in the network, transaction volume, we track the supply of the tokens, the demand of the tokens, the valuations of the tokens, and we do this constantly every day, and we have a ranking of a very diversified basket of all these different tokens so that we can place a bet on higher allocations, or the ones that look more promising, and lower on the ones that don't. And we can continue to rebalance as time goes on. And if some token starts doing a change or an innovation that makes them more attractive and there's more adoption, then we can increase the allocation to that, or vice versa. If you have something that is falling off the weeds and just not getting any adoption, we actually can slowly trade out of it. So we are constantly looking at the space. We are picking the winners, and hopefully in time, as the space grows and consolidates, we can continue to keep the winners as we go along. And on top of that, what we do is we have a risk management filter. So we build a diversified portfolio, but then we control the risk. That means we reduce the volatility of the asset class. It's a very volatile asset class, and I cannot eliminate the volatility altogether. And actually, we don't want to, because we like the upside volatility, but we try to minimize the downside volatility so that we can increase our return per volatility, what we call the Sharpe ratio of the strategy. So we have a liquid strategy with a diversified portfolio that allows us to take advantage of the venture type returns of the asset class, but with lower volatility than if you were just sitting passively on it.
So it sounds to me a little bit like Renaissance fund.
Like which fund, sorry?
Renaissance.
I'm not an expert on Renaissance, but they're more of a systematic fund, I believe. So they're a quantitative systematic fund. So we're not. We are a quantamental fund. So that is model informed, but it is discretionary. I can react to events like the Terra Luna event that we had. We sometimes have positive catalysts in the space, like when Facebook changed its name to Meta, and it gave a big PR push to the metaverse tokens. So I have discretion over the strategy. It's not fully systematic, but it is algo informed and model informed, and it is tracking fundamentals. So it's not just technical analysis type of strategy. It's a quantamental strategy. So we use models to track fundamentals, and I ultimately have discretion on the allocation to hopefully over time increase the alpha of the strategy.
It's very exciting. And I remember long ago when Bitcoin was first coming out, it was really hard to track the fundamentals. People didn't really even know, how would you put something together that would be able to really the value of those fundamentals, how they're driving change in the markets and things like that. So it sounds like there's been a lot of development and growth since then, especially with algorithms like yours.
It is easier to track the data. Like I said, some of the data is on-chain. It's open and it's transparent and everybody can read it and look at it. Right now, there are many places where you can make that job easier because they aggregate it and clean and track and the data for you. It's certainly easier than it was before. So it has come a long way in that sense. We have a lot, like I say, it's part of the ability of the ecosystem to become more formal and a lot more offerings, research providers, data providers. You're aggregating all the positioning data, the on-chain analytics data. We have a lot more clarity now. It's just easier to track than we used to. But then again, the data on-chain was always there. It's a matter of extracting it. But valuation models, on the other hand, are much harder to have one pinpoint this one model. There are more than one that we look at. There's more than one that you can use. And really these things, a lot of the cryptocurrencies, they work through network effects. So it means that the more people are using them, the more value they have. Because it's, think of a telephone network, right? If you're the only person with a telephone in the world, it's not as valuable as if a lot of people have it. And cryptocurrencies have a little bit of that dynamic. So when the network increases, the valuation tends to increase with it. But the valuation models are tricky because remember, cryptos are not really currencies. They're not fully like sovereign currencies, like your traditional currencies. They're not stocks. You don't own equity. They're not actual commodities. The price is not related to the marginal cost of production. So they're a little bit, they're a hybrid, they're different. And that's why you want to look at it at different angles and make sure you understand how they're all very different. That's also something very important to remember. These are all very different. So the way you would value Bitcoin is completely different to the way you would value, say, Uniswap. They are completely different things, two different animals. And so you want to understand which, what each one of those are, how, they work, what's their utility, what's their tokenomics, as they say. So it's the fundamentals of each of these and value them accordingly. And that's what we try to do. We try to follow each of these, understand them well, value them accordingly, track the appropriate fundamentals for each one, and place bets in a well-informed way as best we can.
So I must say, this is being completely honest, even moving entirely into the Web3 space now myself, I'm still completely mind blown when it comes to the amount of money people are making in, let's say, NFTs or digital real estate and things like that. It truly does baffle me, and I'm sure it does for a lot of people. So what are some things that you've seen that maybe could start to enlighten people like myself of why that really is occurring, and maybe is it opinion on, is it important, let's say, for the long term of, let's say, next 50 plus years, of how those dynamics are developing in our world in relation to the real money supply?
They're different, right? These give you, if you will, a unique ownership of, it could be a piece of real estate or a piece of an art piece or a song or etc. So you want to think of an NFT more like a piece of art. It's like a unique, say, Picasso, right? Which is different than Bitcoin, where you have many coins floating around. There's going to be 24 million and whatever. Different tokens have different amounts of supply. These are unique and they are useful for different reasons. You can tokenize a lot of, you can think about tokenizing, going back to that Picasso, you may want to tokenize that Picasso in different little pieces and then sell, instead of just selling that one painting, you can sell the ownership, the fractional ownership of that painting to different people. And that's something that, could be very useful. So it's not only the rich and famous can go to an art gallery and buy a piece of art, but, you could have laymen invest in an art piece that they think has a lot of value in a little fraction because it's tokenized to fractional ownership. So for example, that's a potential use. Whether you think that has value or not, it's a question. Senda, my fund, does not invest in NFTs. So this is not my area of expertise. But you can see how, as much as people trade art or song ownerships or many other things, why they may want to do that. Or there's applications to real estate you can think of, or there are applications to many other things. The fact that you can tokenize a lot of ownership is likely going to open a lot of doors in the future. So those are a little different than what other cryptocurrencies offers. But the space offers a lot of growth if you're investing, again, in the properly vetted tokens. If you obviously get caught in an unfortunate Ponzi scheme, it's a problem. If you have a friend saying they've made 10 times returns and you just invest without looking at where you're investing, it's a problem. But if you really know what you're investing in and you do your research, there's a lot of opportunity, and these very high returns are very high because they're venture type returns, because all these things are still new, they're underowned, they're offer disruptive. Ethereum is obviously the first ecosystem, the first blockchain offering smart contract platforms, and with the smart contracts we've been able to do a lot of things, and we have now the metaverse and DeFi, and so there's a lot of things that come out of that, and those huge new opportunities obviously offer outsized returns. And that's why there is all the excitement around the crypto and all the high returns that the crypto can offer. But together, all the frauds as well. Again, my message is invest, but do your homework, do your due diligence, make sure that it's a safe place that you are investing in. And if you do that, I think the space offers a lot of very attractive opportunities ahead.
Yeah, and actually you gave me an insight there that popped in while you were saying that it's not a one-way street buying an NFT, right? If you, let's say you could sell that ownership back, right? It's the appreciation of that asset. There you go. It's just a different.
Nothing is a one-way street. Whenever you invest, it's hugely volatile. It can go up, it can go down. You definitely need to be aware of that and make sure you understand the risks. And particularly NFTs have a lot more volatility even your regular cryptos, because again, they represent a unique piece of ownership of a unique, art or real estate or song or whatever it is. So that's going to go up and down in price. And as we've seen, and they're hugely volatile. So I'm not saying they're not good investment opportunities, just again, make sure that you like what you're, like you would do anything else. You just wouldn't just go blindly and buy house, right? You do your research and you make sure you're investing properly, and you have to do the same thing with NFTs and with anything else.
So for Senda Digital Assets, what is the number one goal that you're achieving very long term? And what's that time horizon you'd like to think on when it comes to your goals?
So I would love to be the place, the go-to fund for discretionary, directional exposure to the crypto asset class, to the extent that an investor wants to have, or an institution or high net worth individual. And in the case of Senda, we can only accept accredited investors. Even the investor wants to diversify into the crypto asset class and get some directional exposure there, I think our strategy can do it in the best possible way. And hopefully I'll be there when all the big institutional flows come in the space, and I can be ready to receive them.
Yeah, this has been a really great conversation. You have a lot of amazing insights. And honestly, as you've been talking, there's just been so many questions popping up because what you're saying is just so rich of information. Very much enjoying this. And that's what I think you already mentioned it, but really your number one takeaway that you want people to have. You mentioned it about invest, but take your time, consider the right options. Anything else that you really want people to know?
Yeah, and the fact that we have seen a downturn in the crypto markets has spooked a lot of people. They don't understand why this happened. My message is there is a lot of potential. What happened was the consequence of a poorly designed stable coin, but that doesn't take away from the technology the blockchain technology, the excitement and the potential and possibility of all the rest of the coins and tokens that are of high quality and high potential in the space. And so just remember that what just happened was not a problem with the technology per se, but with the financial architecture design of a particular stablecoin and a few players that were really blindly clipping yield from that stablecoin and not properly risk managing their portfolios. And they had a lot of investors caught there. That's what eventually led to a deleveraging. And what we saw, a stable peg break and a deleveraging episode, is just very common in traditional financial markets. There's nothing crypto specific. So nothing that happened should dissuade anyone from believing in the crypto technology and its potential for the future. It is very volatile. It's very nascent. There's a lot of things that we don't understand. And that's why we have these big volatility events. But nothing that happened has dented the belief that the crypto ecosystem can and will disrupt a lot of the traditional financial markets in the future and has huge potential going forward.
To talk about that belief, you've excited me about the crypto and Web3 space even more. So thank you for that. And hopefully a lot of people that are watching this as well that end up watching this. That seems to be everything. So if you're an accredited investor, reach out. What's the best way to find you, Tania?
You can reach out in LinkedIn. That's pretty easy, straightforward. We also have a webpage with contact information there. If you're interested and you are an accredited investor, we'd be happy to talk to you.
Perfect. And I'll include both those links in the description. Thank you all for watching this episode of Titans Up Today.
Hey everyone, thank you for watching this episode of Titans Up Today. What did you learn from it? Make sure to drop a comment below with your most valuable insight so that other people can engage in the conversation around what this speaker brought to the table. And then on another front, make sure to subscribe so that every time we drop a new episode, you will be notified. And that way you can keep fueling your dreams and your brain with fresh insights which can help you along your journey and along your path to your goals. So thank you so much again, and I look forward to seeing you in the next interview.